What's up YouTube? Dougie Chong here. Welcome to my third YouTube video. So why am I so excited about index funds? Well, by the end of this video, you'll find out that index funds are one of the easiest ways to start investing, and I'm excited to show you guys how you can start as well. So in today's video, I'm going to be covering three main topics. The first topic is what exactly an index fund is. The second topic is how do index funds compare against picking individual stocks. And the third topic is going to be what index funds I personally recommend. Again, I am not a licensed financial advisor. These are just my opinions and for entertainment purposes only. So what the heck is an index fund exactly? Well, you can think of an index fund as a collection of companies. So instead of picking individual companies that you believe in, you can pick an entire basket of companies, such as the energy sector, the banking sector, or the technology sector. A very popular index fund is known as the S&P 500 index, which stands for the Standard & Poor's 500 index. This index is comprised of the top 500 companies in America by market capitalization. Market capitalization is the price of the stock multiplied by the number of shares outstanding. This gives you a rough estimate of how much investors value a company. Smaller index funds do exist, and there are even index funds that track something such as the US dollar. But for beginners, I usually recommend just sticking with the S&P 500 index or some other variations. So now that you understand what an index fund is, I'm going to get into how does an index fund compare to picking individual stocks. The first chart that I am showing is of the S&P 500 index for the past 5 years. As you can see, the value of the index roughly doubles over the past 5 years. Now we will look at one of the stronger performing stocks on the S&P 500. That stock is Amazon. This stock over triples its price over the past 5 years, which vastly outperforms the S&P 500 index. Now we will look at one of the worst performing stocks, Sears. Technically, they are out of the S&P 500 index now, but at one point, they were definitely in the S&P 500 index. So they fell from over $40 to about 18 cents now. So from looking at the charts of Amazon and Sears, it seems simple to pick the good stocks such as Amazon. However, knowing which stocks are the good ones is near to impossible. Therefore, by picking the S&P 500 index, you get some of every stock and it's almost guaranteed to go up. You will not get the astronomical gains of a high flyer such as Amazon, but you will also not have the downside risk of a company going bankrupt such as Sears. You might also be wondering what happens in times of recession. So I'm showing this chart now that shows the minor dips at year 2000 and year 2008, where the S&P 500 almost halves. However, in the long term, around 20 to 30 years, the index fund always makes its way back up. The reason that the S&P 500 index constantly increases is that our economy is structured in a way that constantly encourages prices to increase. I could make a whole video on this topic, but just look at this graph and you'll see that the price increases at a fairly consistent rate. So as you can see from the charts, some stocks will outperform the S&P 500 index, whereas others will underperform the index. But the index is generally considered a safer option and will generally go up over time. Picking these winning stocks is akin to winning the lottery, and while some experts are extremely good at finding low-valued stocks, such as Warren Buffett, it takes an immense amount of time when you can simply buy into the S&P 500 index and collect moderate gains the whole way. I'll also mention that the management fee charged by index funds is typically around 0.08% to 0.1%, whereas mutual funds can be 1 to 2%, which is much higher. Even one of the lowest wealth management apps I know, known as Wealthsimple, charges a 0.5% management fee, which is much higher than the 0.1% management fee of an index fund. Also, with Wealthsimple, they fully disclose all the contents of their growth portfolio. Therefore, you are able to completely copy exactly what they hold in their growth portfolio without paying the 0.5% management fee. This fee largely goes to rebalance the portfolio, which means slightly changing the contents, but I do not believe it is worth the 0.5% management fee. So, now that you know all about index funds, I'm going to get into the third section, which is which index funds do I personally recommend. I recommend an index fund known as VFV. It's a Vanguard index fund that tracks the S&P 500 index here in Canada. If you're an American, the ticker symbol VOO is the one for you. I picked both of these ticker symbols because they have very low management fees. The management fee for the ticker symbol VFV is only 0.08%, and the management fee for VOO is 0.03%. Now you might be wondering, why don't I just use VOO since it has a lower management fee? Well, because it is an American stock and I would have to pay some other fees, which makes it better just to hold the Canadian one. I personally hold some shares of VFV and will be looking to increase my position in the future. In a future video, I will also be going over buying strategies and how to strategically buy so that you do not get burned by the market. Thanks for watching my YouTube video, guys. Hope you learned a lot about index funds. Leave a comment in the sections below. Let me know what you think. Which index funds are you guys buying or thinking of buying? Also, please remember to leave a like and subscribe to my YouTube channel. Thanks for watching.